Gold markets are flashing multiple signals right now that are indicating we could be on the cusp of a major historic move up from a huge short squeeze in gold. And one of these signals has only happened a few times in the last decade, and every single time it has happened, we have seen a major move upwards in the price of gold. Ready? Let's dive in. Over the last few days, I've been talking with my friends over at Vaulted, and we were talking about this article that they recently published. And by the way, I've got an affiliate link if you're looking for a place to start buying gold. I love the team over there. They've got great integrity, love the way they run their business. You can sign up with my affiliate link in the description below. And we were talking about this article that they sent out that has the indications of a short squeeze developing right now in gold for a number of reasons. But first, we have to understand what has been going on with the price of gold recently. Let's take a look at this chart of the price of gold, and we can see here since 2020 it's been locked in this channel. It has touched the high of about $2,070 two times, and it has retested this low. Pretty strong support and resistance at this point, since it was resistance back here, support all through there, here, and now it just touched that support again within the last few weeks and has rallied off. One thing to note though is that since the invasion of Russia began, when it first had that spike up again, it has been locked in this downwards trend, this downwards channel, and we are currently hitting the top of that channel. And so technical analysis would suggest that we have a higher likelihood of coming back down, since we have not yet confirmed a breakout of that channel, and we would then expect a retest of support or the lower end of the channel, which I would guess would stop at about 1680 before we finally break out of this channel once and for all. So that's the first warning, that technically speaking, it looks like we probably do have a little bit of downside immediately. The second warning about the price of gold here, before we get into the good stuff, is the major positioning of bullion bank traders. As you can see from this chart, the blue line shows the net short position of swaps, which is going to be mainly bullion bank traders. You can see this blue line is lower than it's been for years, and it's back down nearing into that channel where it was from 2010 through about 2018. And so these swaps, the net shorts, have been reduced by a massive amount, lower than these shorts have been for a very long time. Now, if you don't know what relevance this has, basically what we're looking at is all the potential buyers and all the potential sellers on any market will come together, aggregate the consensus supply and demand, and the equilibrium will be the current market price. Now, if that current market price is expected to be too high compared to the future expectations of the market, more market participants will engage in selling. And then if they're right, this would then push the price down, and vice versa as well. But instead of just buying and then selling what you bought, another way that you can trade is shorting, which is borrowing first and then selling. Well, in order to close out that trade, you're going to have to buy it back from somebody to deliver it back to whoever you borrowed it from. Bullion bank traders engage in shorts all the time, and they have drastically, as you can see again by this chart, reduced their amount of shorts. So over the past few months, they have been buying a lot of gold to close out these short positions. Now the trend is down, so they could continue this path here and get down to some of the more normal levels that they were at in between 2010 and 2018, below that 10 line there. So we could still see some more purchasing coming from these swaps, but given the area that they like to be in with their shorts over the last couple of years, we might expect them to turn back on net to some more selling instead. So that is the second major warning here. Technically speaking, and looking at the swaps, we might have some selling pressure ahead. And now for the good news. They're not the only traders out there, and those are not the only two forces at play when you're looking at the potential price movement of something. So when we're looking at gold, one of the things that we're looking at is insiders stockpiling gold and standing for delivery. If we take a look at the COMEX open interest, we can see a drastic decline here in open interest. We're also seeing a massive number of contracts standing for delivery delivery, 26,000 in just the last few trading sessions, which is only slightly less than the whole of July. On top of that, central banks added 59 tons to their reserves last month and no reported selling took place. So right now, big buyers are buying and standing for delivery, and we are seeing that result in the COMEX vaults being drained of their gold. If you take a look at this chart from MikeSay98 on Twitter, we can see that COMEX vaults volumes are currently at the lowest level they've been since June of 2020. So we have bullion bank traders who have positioned themselves to be more long than they have in a couple of years. Potentially a bearish signal, but potentially a bullish signal if they're trying to get ahead of a new bull run that they know is about to take place. We've also seen a massive drop in open interest on contracts. We've seen the vaults, the COMEX vaults, start to get drained, lowest levels in a couple of years. And finally, the big kicker here. This is the big signal that has only happened a few times within the last decade. This one is speculative bets against gold. We are currently sitting at the second highest level on record. You can see the last time it was higher than where it's at right now was near the end of 2018. And if we take a look at this chart of gold, where gold was at during the end of 2018, that was one of, if not the best times in recent history to go long gold, as it was trading at just about $1,200 at that point, right as speculative bets became most short. So who are these speculative bets? This is managed money. If you take a look at this chart, we can see the red line shows the net longs, and there have been a few times when managed money got net short over the past decade. One of those was in 2015 and then 2016, and then another time in late 2018, and we've just become net short again from managed money. Zooming out a little bit further to 2006, this is a little bit of an easier chart to see every time it turns red there. Those are where managed money become net short. If we take a look at this chart, we can see the 52-week performance of every single time that this speculative short selling hit that net short, a surge in speculative short selling. There was only one time where we did not have a return after 52 weeks. The orange line initially spiked and then came back down to have a net return at 1 year of basically zero. But every time after that, there was a large increase in the value of gold every time speculative shorts surged. We can see the gray line there, 9% return after a year. The purple line, about 18% after a year. The green line, about 21% after a year. And then the blue and red, over 30% after just 1 year. And if we take 2 years into account, when September of 2018, when speculative shorts reached that all-time high, we had a 2-year performance of just about 75%. And percentage-wise, if we had a repeat of a 2-year performance of 75% as we had from 2018 to 2020, that would take us from current levels up to just about $3,000 per ounce. Is this guaranteed? Absolutely not. But given the fact that we are seeing signs of capitulation, we are seeing the vaults getting drained down to levels they haven't been in a few years, we are seeing positioning changes by the bullion bank traders, we're also seeing a very big contrarian signal from managed money, which is historically wrong every time it becomes net short. This is flashing some major buy signals for me, and it doesn't even take into account any potential black swan issues like a China-Taiwan thing escalating. So in my opinion, right now is a time where I'm looking at buying and buying and buying, especially every time we get a little bit of a dip. It looks like one of the best times in recent history to start to accumulate more gold at a discount. Don't take my word for it. I'm just some guy on the internet. If you'd like my gold buying resources, I've got links in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.